Let's get to Jason Furman, former Council of Economic Advisors Chair. Jason, it's great to have you on. Do want to get your reaction to what we heard from Fed Chair Powell. It was the second straight meeting where we saw the Fed hold steady. We just had a conversation with David Zervos about the fact that maybe this was the most dovish we've heard, or we'll say least hawkish we've heard Powell in a while since inflation reared its ugly head. Do you see it the same way?
I don't exactly see it the same way. I do think they raised the bar on more rate hikes, and they raised it so high that we may not hit it, and that's completely fine. But the sense in which it's not dovish is he's sitting there with a 10-year rate of around 4.8% and basically saying he's fine with it, that we're going to continue with something like that. So in some sense, we're in a tighter financial position than we've been in for the last 2.5 years, and he's not letting up from that position.
Yeah, and we saw that at the FOMC statement. The word financial was added, tighter financial and credit conditions for households and businesses. How long does it take for that to translate to economic activity? Does it move more quickly than the Fed's own interest rate hikes?
I think it moves more quickly. I mean, look at where mortgage rates are, right now, above 8%. And you're seeing effects of that already in the housing market. One thing that Chair Powell was very good about, there was no victory lap there. He knows that inflation has come down, but that it's still way above where he wants it to be. But the fact that we've made progress, the fact that there's more tightening in the works from those financial conditions in addition to credit, means they can afford to be patient. And that was basically what he was saying today.
So, Jason, we still got this tight labor market. We got a jobs report coming up. After this color from the Fed, what's most important in that jobs report?
I continue to look at wages. They have moderated some. We didn't see that same moderation in the ECI that we saw in the average hourly earnings. But that'll be the first thing I look at, because that's the way you referee between how much of the strong labor market we have is demand, which is a concern for the Fed, versus supply, which is perfectly fine and sustainable. And it does look like a lot of the growth has been coming from supply.
We had Gundlach on last hour on CNBC on Closing Bell talking about the impact on bonds here. Take a listen.
I believe that we've started a bond rally here. I think we've had such a brutal increase. I think the Fed is sounding the right tone. I do think rates are going to fall as we move into a recession in the first part of next year.
Does what Jeffrey Gundlach said there make sense to you?
I mean, as we move into a recession is far, far more confidence about a recession than any forecaster should have. I'd hope we would have learned that lesson over the last year. A recession is always a possibility. If we get one, we're going to see big rate cuts. But the most likely scenario is no recession. I think the most likely scenario is inflation stays above 3%, in which case the Fed is not going to want to see those long-term rates come down very much, and they're certainly not going to lower their short-term rate.